Okay, welcome to today's class. Today we are going to look at IAS 7 statement of cash flow. The purpose of statement of cash flow is to ascertain the changes in cash flow. You understand? Is to ascertain the changes in cash flow, and cash flow statement is part of the financial statement that an entity is expected to prepare. So in discussing statement of cash flow, it is important that we understand the three categories of statement of cash flow. So cash flow flows in from three activities: operating activities, investing activities, and financing activities. So let's take the definition of term. Cash and cash equivalents. Cash comprises of cash in hand and cash in the bank account. Cash equivalents are the short-term, highly liquid investments that are readily convertible to a known amount of cash and are subject to insignificant risk of changes in value. Now, cash flow, this is the inflow and outflow of cash and cash equivalents. So when we talk about cash, cash is actually the liquid cash that you are holding. That is the money in your hand. Then it also includes the money in bank accounts. Cash equivalents are short-term marketable securities that are easily convertible to a known amount of cash and are subject to an insignificant risk. Example of cash and cash equivalents are treasury bills, treasury bonds, and treasury certificates. Now, before we take a question, I would like us to look at the format of cash flow. In this format, cash flow, there are two methods of preparing cash flow: direct and indirect method. Indirect method actually makes use of this is a format of cash flow. We have net cash flow from operating activities. They gave us the value. So we now have cash flow from investing activities. This is it. So in this cash flow from investing activities, we have items like acquisition of shares or debentures, purchase of plant and machineries, proceeds from sales of non-current assets, interest/dividend received, net cash flow from investing activities. Cash flow from financing activities, this includes and not limited to proceeds from issue of shares, proceeds from new loan, repayments of loan, dividend paid to shareholders. When you add the three totals of the three activities, it will give you what we call net increase or decrease in cash and cash equivalents. Then the cash and cash equivalent brought forward will be added. You now have your cash and cash equivalent carried forward. So statement of cash flow enables us to study the liquidity of the firm. It enables us to look at the liquidity of the firm. In looking at this liquidity of the firm, we can tell that the firm is going to have or will have or is having or will not have a liquidity problem. That is to say, it can be able or might not be able to retire its obligations as they fall due. Operating activities. IAS 7 permits two methods of preparing operating activities, and they are direct method, indirect method. However, we shall be looking at this now. Indirect method is a re-preparation of the statement of profit or loss using cash basis of accounting. That is what I always tell my students. Is the re-preparation of the statement of profit or loss using cash basis of accounting. So what we start with normally is to take the profit before tax and adjust the non-cash items. The non-cash items are depreciation, profit or loss from sale of non-current assets, and accrual-based figures such as interest expenses, movement in working capitals, inventory, receivables, and payables, workings. Cash flow from operating activities. We have cash from operating activities, we have PBT. Now, remember, when we look at the format of cash flow, they gave us only one figure for cash from operating activities. We were given only one figure for cash from operating activities, which is this. So at this point, we are going to look at how you can calculate and ascertain your cash from operating activities. So this is another format using indirect method. So we have profit before tax to be this value. You add back depreciation, you less sales of non-current assets, profits from sales of non-current assets, you less it. So you add loss from sales of non-current assets, then you less profit. Why are we lessing profit and why are we adding loss? When you made loss in profit or loss account, you deducted it and it is a non-cash item, so you have to add it back. When you made profit from sale of non-current assets, you added it to your profit and it's a non-cash item, so you have to what? Less it. So that is why we deducted profit from sale and added loss from sales. Then financed cost, you must at all time at this point add your financed cost. So we now have net cash flow before changes in working capital. Now you bring in your working capital. Majorly, we have inventory, receivables, and payables. We have inventory, receivables, and payables. So now, if current assets increased over the year, it is an outflow of cash. It means you spent more money buying inventory. If receivable increase, if current liability increases during the year, it means you borrowed more money, you got more money, so you add. So these are the logic. When current assets increase, you less the value. When current liability increase, you add the value. Well, we shall do much on this when we start computation. So now you now have cash generated from operation to be this value. You have cash generated from operation to be this value. Then you now take care of your interest expenses, you less it, you less your tax. You must do workings here. I always tell my students, sometimes you might be required to carry out what? A workings. You might be required to do workings here. So this might be your working number 1, interest. Then this might be your working number 2. Good. So when you now deduct these two, you now have your net cash flow from operating activities. Net cash flow from operating activities. So we now look at direct method. This method calculates cash from operating activities using ledger control accounts to adjust cash received from customers, cash paid to suppliers, cash paid to workers, cash paid for operating expenses. So we now have cash flow from operating activities. So cash received from customers, you bring it in. Cash paid to suppliers, you deduct it. Cash paid to workers, you deduct it. See, that's why it's in brackets. Then you add all to give you cash generated from operation. You now take care of your tax. just as you did in the indirect method. You also take care of your interest. Now, you would ask yourself, where are these figures from? These are imaginary figures. So we have this. So IAS 7 allows variations in the way that statement of cash flow presents the following. Now, according to IAS 7, interest can be treated, interest received, dividend received, interest paid, dividend paid. Now, interest received and dividend received can be treated as an operating activity or investing activity. Interest paid and dividend paid can be treated as operating activity and financing activity. Are you there? You must note this. They can even ask you this in the exam hall. So let me bold it to tell you how important it is for you to master it. Are you there? So that is that for that. So we continue. So accrual based figures. So this is a format of adjustment. This is a format of adjustment. So, but there is no need for us to waste time here. We'll take a question and I'll start teaching you how best you can do this. So we have practical question 1. So in this practical question 1, we'll be appreciating the best way we can handle our question in statement of cash flow. So we are going to take this question. You see, it's a very long question, ICANN question, to look at the best way we can solve issues relating to statement of cash flow. So we have Usman PLC statement of profit or loss and other comprehensive income for the year ended at the 1st December 2013. Revenue 1.6 million. Interest income 10,000. Gain on sale of profit of plants 8,000. If you add together, you have this. And I have expenses, cost of sales, wages and salaries expenses, depreciation on plants and equipment, interest expenses, other expenses. So we now add all the expenses. Let's now have profit before tax. We have profit for the year. We now have income tax. We now have profit for the year. We now have other comprehensive income. So we have gain on available for sale investment, income tax, and we have total comprehensive income for the year. So we now have comparative statement of financial position. So you can see the one of 2013 and the one of 2012. So the one of 2012 is the beginning of the year, while the one of 2013 is the end of the year. So we now have our cash at bank, account receivable, inventory, prepayment, interest receivable, plant and equipment, investment, intangible assets, accounts payable, wages and salaries payable, accrued interest, other expenses payable, current tax payable, deferred tax liabilities, long-term borrowings, share capital, retained earnings, available for sale reserve. Additional information. Plant which had a carrying amount of 20 million naira was sold for 28 million naira. And new equipment was purchased for 100 million naira. Intangibles valued at 30 million were acquired for cash. Borrowings of 20 million were made during the year and received in cash. Dividend paid in cash amounted to 100 million. You are required to prepare the cash flow statement for Usman as at December 2013 in accordance with IAS 7 using direct method. 20 marks. Now, what I did first is to prepare. What I did first was to ascertain the to provide the explanatory notes to profile the explanatory notes. So the explanatory notes, solution above was profiled for indirect method. The PPE sold earned a gain of 8,000. The PPE sold earned a gain of 8,000, and the gain is to be deducted from profit before tax, and the sales proceeds from PPE is to be added to investing activity. The carrying amount sold should be the carrying amount of that portion sold should be deducted from PPE. The newly purchased PPE should be deducted from investing activities because it is an outflow of cash. The newly purchased PPE should be deducted from the investing activities of the company because it is an outflow of cash. The newly acquired intangible assets of 30 million should be deducted from investing activities. The interest expenses of 8,000 and interest received of 10,000 are accrual-based amount and should be adjusted from PBT. Depreciation is a non-cash item and should be adjusted from PBT. Now, solution. Before I will present the solution, we'll first of all look at workings. So, working number 1 is interest paid. In our interest paid, it is important that we identify some paramount activity, which is, this is interest paid. This is the center which divides the two sides of the account. This side is the debit side. This side is the credit side. I hope you are there. Good. Now, interest is a liability because it is accruals. So the balance brought forward will have a credit balance. So the balance carried forward will be at the other side. So you can see the balance carried forward here. Now, you bring in their value. The balance brought forward is nil. The balance carried forward is 400. Now, the interest expenses in the statement of profit or loss is 8,000. That is financed cost. So you bring it in 8,000 naira. That's the interest expenses, 8,000 naira. So with this, you take total. So the two sides of the account must be equal. Are you there? Since the two sides of the account must be equal, what do? We calm down and find the difference. So the balancing figure will now be 8,000 minus 400 will give you 7,600. That is what I call this balancing figure. This is interest paid, and this interest paid will be treated in operating activity. So we'll now move to tax paid. Tax is a credit liability. Why is it a credit liability? Let me show you why it's a credit liability. Because in the liability side, you can see current tax payable, so it's a liability. Are you there? You can also see accrued interest is a liability. This one is 400, which is for 2013, while this one is for 2012, which is new. So that is why they are all liability items. So we'll come back to it. So the balance brought forward of current tax is this. The balance brought forward of current tax is this. This is a balance brought forward of current tax. Since it is 28,000, we bring it here. Deferred tax is 10,000, we bring it here too. Deferred tax is 10,000, we bring it here. The balance carried down of tax is 32,000. For deferred, it is 17,200. This one is current tax, which is income tax. Now, the tax provided in the statement of profit or loss were 60,000 in the statement of profit or loss, and OCI was here also. So with this, you now take total. The two sides of the accounts must be equal. You mustn't forget. Since it must be equal, we'll come down and find the difference. So it will now be 99,200 minus this, and this will now give us 50,000. This become our interest paid. We are done with working number 2. The next one is property, plants, and equipment. Property, plants, and equipment is an asset, so the balance brought forward will be at the debit side. Liabilities will have a credit balance, while asset has debit balance. So balance forward brought forward is this, then balance carry forward is this. Now the depreciation during the year will be at the credit side, deducting our balance brought forward to be at the credit side. Disposal was made, which is this, so you also bring it here. So you take total. Are you there? You take total. So it becomes this plus this, 50 plus 20 plus 330 will give us 400. So 400 is the total amount. 400 is the total amount. Since 400 is our total amount, take away 100, 300, which is balance brought forward. You now have our acquisition of equipment, which is 100,000, and this is our balancing figure. Let me put it here. Balance figure. Balance figure. Balance figure. So we come here, interest received. Interest received. So interest received, we have interest received. Now, interest received is an accrued income. An income. An accrued income is an accrued income. Since it's an asset, it has debit balance. So that's why it is here. And balance carry forward will be here. So the one of 2012 is brought forward, one of 2013 is carried forward. Now, the interest received in the statement of profit or loss will be credited here. So if you add it, you have 13. So minus the balance brought forward of 200, you now have difference of what? 10,100, which is also balance figure. Remember, that was what I've been calling it all this while. So I hope you have learned how to get a balance figure. Good. So we have intangible. Intangible is an asset. So balance brought forward is here, and balance carry forward is here. This is balance carry forward is here. Balance carry forward is here. Now, so we have 300. So you take total 300. So minus 0 here. So you have 300, which is 30, which is our acquisition of tangible assets. Available for sale investment. Available for sale investment is an asset. So balance brought forward is here. Balance carry forward is here. Then we have gain or revaluation of available for sale investment. So if you add up to give you 28,000, you can see it. 24 plus 28, 4,000 will give you 28. So, and there is no value here. There was no disposal. So that is why we have 28,000. So they are equal. So dividend paid, that one is easy to calculate. We are already given to be 100, so no need wasting our time. So with this, we'll now look at the solution. So we'll come back to the solution. We've finished the workings. So the solution stated cash flow from operating activities. So we have profit before tax to be this 208,000 naira. Adjustment interest expenses will be added back. You should know that interest expenses should be added back if it is an income. If it's an expense, if it is an expenses, you add it back. Interest income should be deducted. Interest income should be deducted because it is a non-cash item. So depreciation of 50,000 should be added. Depreciation of 50,000 should be added. Then gain on disposal should be deducted. All these are non-cash items. So by the time you add all this value, you have for okay. So when you add all these items, like 8,000 minus 10,000 plus 50,000 minus 8,000 will give you 40. So add this 40 to our profit before tax. We have 248,000 naira. Now you now take care of your receivables and current assets. So you have account receivable is 140,000 and the ending value is 158. So the opening value is 140, the ending value is 150. It increased, you deduct. You see, it increased, you deduct. Inventory was 130. At the end of the year, it was 140. You can see it. It increased, you deduct. Prepayment was 16. At the end of the year, it was 19. It increased, you deduct. You see, increase in payable, it was 84,000. At the end of the year, it is 90. It increased, you add. I told you the other way around. If current asset is increasing, deduct. If current liability is increasing, you add. So this should guide you. So if current assets decrease, you add. If current liability decrease, you less. Okay. Then decrease in other expenses payable, it was 36 and it is now 6,000. Sorry, this is 600. It's now 600. So 36 minus 600 will give you 24. Then you have increase in wages and salaries payable. It was 8,000 and it increased to what? To 10,000. You have 2,000. So you add this should be 3,000. This should be 3,000 and this should be 600. Sorry for that typo error. So let's verify. Decrease in other expenses payable. So expenses payable, let's look at it. You can see interest receivable, accrued interest, other expenses payable is 36 and 6,000. 36 and 6,000. The opening balance is 212. The opening balance is 6,000. The closing balance is 36. So it's a decrease. I didn't place it well. It's a decrease. It's a decrease. So it should rather be opening value is 6,000 and closing value is 36. So it decreased. So when it decreased, you what? You less. If it increase, you add. If it decrease, you less. So that's why we less this. You can also see salaries payable. At the beginning value was 8,000. The end value was 10,000. So it increased, you add. Why are we adding? When your liability increases, it means you are owing people, so you have not paid them, so you receive money. If I'm owing my worker 10,000 naira at the end of the month, I'm richer by 10,000, so my cash will increase. If I now pay my worker, my cash will decrease. So that is why an increase in liability is an increase in cash. So you add all this, you bring it here, give you minus 25,400. So when you add it to this, you now have 222,600, which is our cash generated from operation. Interest paid is our working number 1. You less it. Tax paid is our working number 2. You less. So you now have 165,000, which is cash, net cash from operating activities. So you now come down and look at cash flow from investing activities. Now, cash flow from investing what? Activities. This cash flow from investing activities, so we'll now look at acquisition of property, plant, and equipment. That should be working number 3. Working number 3. So what do we have? It's minus 10,000. We acquired assets, so you less it. Buying assets, cash is flowing away or flowing out of the company. So proceeds from disposal of property, plant, and equipment. Proceed from disposal of property, plant, and equipment. Proceed from disposal of property, plant, and equipment is what? 28,000. Is 28,000. So that proceed from disposal of property, plant, and equipment is 28,000. So this proceed, we receive money when we sold it. So that is why it is here. Interest received is 10,100 naira. We did it in our workings too. Acquisition of intangible is an outflow acquisition. We also did it in our workings. That was the first thing we did. I hope you can remember. Let me also go and remind you of them. Property was working number 3. So this value is what we are making use of. You understand? Another one is interest received is an increase in cash, which is this. Another one is available for sale investment. We have acquisition. Then the last one is dividend, which I told you was already given to us. So with this we add all this. So you now say minus 100 plus 28 plus 10,000, 100 plus 30,000 will give us this. So we now have net cash flow from investing activity. So we now look at cash flow from financing activities. I hope you understand. So we now have increase in long-term borrowing. The beginning value was 120 and the ending value was 140. So we borrowed money of 20,000 naira during the year. Dividend paid, what we are already told, is 100,000. So if you add, you have 80,000. So when you add all this gives us 6,900. Decrease in cash and cash equivalent will give us 6,900. So now have cash and cash equivalent brought there forward, which was given to us in the question. Let me go and show you cash and cash equivalent brought forward. You can see it here. You can look at it. Cash at bank at the beginning of the year is 120. At the end of the year is 1,300. So you come back. This 130, add this to give 1,300, which is the same with the closing value of cash at bank. So this is how our cash flow questions was solved. The question will be dropped in your group. The note will be dropped in your group chat. Go through it and drop any question you have. And you can watch this class anytime, any day. Just let us know. Do have a nice